Nnamdi, great to have you. And I love that you gave us a sense of some companies that you like and some companies that you don't like. I want to start with the don't like, at least the overvalued, you say, particularly Bill.com. I think it's interesting because isn't one of the things that's happening in behavior change that small businesses really have to, adapt to the cloud and digital processes? I mean, isn't that what Bill.com is about?
Well, thanks for having me. It's great to be here. And on Bill.com, so a couple things on that company. I think the first thing is definitely I think they benefit from behavioral changes in terms of more small businesses wanting to do billing and wanting to do payments. The issue with that company is just really it being overvalued. If you look at the company's revenue and actual revenue performance, enterprise value to revenue multiple, for example, the company is much more highly valued than its peers. So it's a business that I believe is overvalued today, but may have some long-term prospects given the reasons you described.
Okay, at the same time, you like Zoom, which has had quite a run. So tell me the justification there, because it must involve believing that they can really deliver on this platform vision that they've been talking so much about over the past few months.
Definitely. So maybe just to step back, at 645, we're big believers in this idea called the behavioral change economy. And that idea is basically that changes that were enabled by COVID, behavioral changes, both consumer and business changes, will be long-term permanent changes. And so what's happened over the past year is that there's been an acceleration of crossing the chasm. More people are adopting behaviors that they wouldn't have otherwise done. And Zoom is a perfect example of that. So if you look at the company's growth, it's grown over 400% over the last year. But we believe that people will continue to use Zoom. For example, my parents are frequent Zoom users, and I never would have seen them on Zoom before the pandemic. But once the COVID is over, they will continue to use it. And so we're believers that those types of companies will have long-term permanent impacts. And Zoom is a great example. The company is also valued at a pretty reasonable multiple of revenue, so right around 22 times revenues, which is actually lower than some of its peers, and it's growing a lot faster than many of its peers. That's why I think that company has very long-term potential.
Nnamdi, Leslie Picker here. Also
Leslie.
In your overvalued companies camp, you have SPACs, particularly technology SPACs. I'm curious why you say that, especially as venture capitalists are beneficiaries oftentimes from these SPACs, which are taking some of the earlier stage companies public at valuations in many cases that most people wouldn't have thought possible prior to this huge SPAC wave. So why do you think that the traditional IPO method is still better?
Well, SPACs have provided an interesting liquidity model for private companies. And the benefit of SPACs are one that they enable companies that may not have as predictable performance metrics, may not be as as profitable as other companies, may not be as established, to have a route toward liquidity and also be able to access another shareholder base. And that's very positive. There are a lot of companies that can fit very well into that construct. The issue I have today with SPACs is really the amount of supply, the number of companies that are accessing that market, and in particular, the blank check SPACs that may not have a lot of substance when you actually look at the underlying targets that they're looking at in the target business models. And so really it's a question of kind of supply and demand. The reason that at 645 we're strong proponents of the IPO model is that it's really a tried and true model. And in order for companies to get public, as you know, there need to be certain historical performance benchmarks. There need to be a certain number of years of financials. And we believe that's really a necessary kind of check and balance, so to speak, in terms of companies with really high quality long-term financial prospects. The three things we look for at 645 in terms of companies are one, visionary founders, two, companies with a defensible moat in their business, particularly a product and service that's hard to replicate, and finally, really strong performance metrics, what we call predictable performance metrics. And we believe that the IPO route is a great avenue for companies. There will be some great SPACs, definitely. It's more a question of kind of the number of SPACs and the volume of SPACs and kind of the overall quality of those companies.
Shepard Smith here. Thanks for watching CNBC on YouTube.